Yeah, Sophie, it's for 30% your term mark. Good luck.
What? I don't get this. What is break even? What is variable costs? What's an economy of scale? What's forecasting? I don't know this. God, I don't know how I'm gonna do this. It's a stupid thing. I think they want to kill me. How am I supposed to do this? I'm gonna fail. Go die. Wall of shame. I'm gonna take a nap. I'm Cat, the study rat.
I'm Guy, the study freak.
And I'm Ben, the study fan.
And we are the
Study Squad.
Study Squad.
Oh, hello there. I'm such a bookworm, I didn't even see you. I'm Van, the study fan, and today we'll be talking about the definitions. One of these definitions is indirect costs. These are costs which are not directly related to the product and are often called overheads or overhead costs. Another cost is marginal costs. This is an extra cost a business will incur by producing one more unit of output. Another one is direct costs. These are costs that can be directly related or identified with a particular product or output. Another cost is fixed costs. These are costs which don't vary with the number of items sold or produced in the short term. Average costs is the total cost of production divided by the total output. Total cost is the combined total of fixed costs and variable costs. Lastly, there are variable costs. These are costs which vary with the number of items sold or produced and are often called direct costs as they are directly related to a particular product. That's it from me.
Hi, it's Guy, the study freak, and today I'm going to talk to you about the break-even graph. Firstly, break-even, which is the point over here, is when the total costs of a business are equal to the total revenue. Firstly, there are three factors that influence the break-even point. Firstly, we have the fixed cost, which is the line over here. If the fixed cost increases, the break-even point will shift further to the right in the graph. And if the fixed cost decreases, it'll move further to the left. Secondly, we have the selling price. If the selling price increases, the break-even point will move further to the left on the graph, and if it decreases, it'll move further to the right. Then we have variable cost, and if the variable cost increases, the break-even point will move further to the left, and if it decreases, it'll move further to the right. Margin of safety is the extra units produced beyond the break-even point for a business. This is equal to the amount of goods sold in the budget minus the break-even point, which can be seen over here on the graph. Also, profit in the business would be the margin of safety times by the contribution of each good. Freak again. And now I'm going to tell you how to calculate the break-even point of a business. Firstly, the break-even point of a business is the fixed cost divided by the contribution. This can vary depending on the variable cost and the selling point. If the variable cost goes up, the break-even point will go up, and vice versa. So if it goes down, the break-even point will go down. If the selling price increases, the break-even point will go down, and vice versa. So if the selling price decreases, the break-even point will go up. Also, the break-even point can impact on many business decisions. It helps them know how many products must be sold in order to break even and cover their losses. Also, they'll also be able to know how, if the selling price and the variable price will vary, how the break-even point varies from that. Hey, it's me again, Guy, the study freak. And now I'm going to tell you the advantages and disadvantages of break-even. Firstly, the good advantage of the break-even chart is that managers can read straight off the graph and see the expected profit or loss to be made at any level of output. Also, the impact on profit or loss of certain business decisions can also be shown by redrawing the graph. It can also be used to show the safety margin, which is the amount by which sales exceed the break-even point. Okay, now for the disadvantages. The disadvantages of break-even charts is, firstly, they're constructed assuming that all goods produced by the company are actually sold. Also, business costs only remain constant if the scale of production does not change. Break-even charts concentrate on the break-even level of production only, where there are actually other aspects which need to be taken into consideration and analyzed as well. Lastly, costs and revenues are not always drawn in straight line, like it's depicted in the break-even chart. That's it from me, Guy the Study Freak. Good night.
Hi, it's Kat the Study Rat, and I'll be talking to you about budgets. What is a budget? A budget is a detailed plan of the allocation of funds in a business. The uses of a budget is to predict the sales or consumer demand, the exchange rate of the currency, and the wage increases. An example of this is forecasting. The types of forecasting are looking at a trend, which is the pattern of sales that the business has, and therefore they use these patterns to predict the new budget. Another type is the line of best fit, where you use a graph and you plot points on it, and you also use it to determine the budget. An example of this is a forecasting graph. And to show this type of forecasting, I shall be bringing up my fellow squad member, Guy, the Study Freak.
Hello, Kat.
Hello, Guy. So, this is a type of a forecasting graph, right? Where it actually shows you the amount of money and the months in the year from January to December. Okay, so basically just shows you that, for instance, in January they predicted that the budget will be 5,000 rand, and in December that the budget will be approximately 7,000 rand. Another type of budget to show budget is using a budget table, where this actually shows you the budget, the actual, and the variance. What the variance is basically it's the difference, and I'll show you the positive and the negative difference. So for instance, over here with the starting of cost of area, the budget is 10,000 rand or $10,000, sorry, and the actual is 8,000, so therefore they have gained from it approximately $2,000. But in this case, as you can see here, the variance is in brackets, meaning that it is negative because the budget was $9,500 and the actual was actually $10,500. Therefore, it's a negative. Therefore, we call it an adverse. So those are the two different ways of showing a budget. Thank you so much for listening to me, Kat,
So long.
the Study Rat.
So long.
And now I shall be talking to you about economies and diseconomies of scale. Economies of scale is when there's a decrease in the cost, but there's an increase in the business size. The factors of economies of scale is marketing, managerial, purchasing, external, technical, and financial. For the purchasing, this is when a business buys in bulk, and the unit cost is reduced and they get better deals. With marketing, the advertising is spread over more units, so they're using outsourcing now. For managerial, the business will be able to attract higher or highly qualified managers, therefore the efficiency will increase. With external, their suppliers will be close by or nearby so that they'll be able to sell the goods much quicker and more efficiently. Financial, this is when the banks give a loan to bigger businesses because they're more secure and and the risk is spread over more units. With diseconomies of scale, this is when there's an increase in cost when a business grows beyond a certain size. So the types of economies of scale is that this is when a business becomes insensitive to market change, when communication is much difficult, and also there's a huge difference between the lower levels and the higher levels of management, or the workers and the managers. And also workers don't feel valued in a business. So that's just to summarize what economies and diseconomies of scale is. It's Kat the Study Rat, and thank you for listening.
Well, that's it from the Study Squad. Good luck for your test. See you next time.
Study Squad out! Oh my gosh. I think I get it now.